only on Bloomberg Quint.
Okay, it was a decent quarter for M&M Financial in a rather subdued quarter for all the NBFCs this time around. NII was up 20%, profit was down 20%, but that was on account of an exceptional item last time around. Asset quality continues to improve for the company, but to get more details on how the company is expected to do going ahead, we are joined by Mr. Ramesh Iyer, MD and Vice Chairman of M&M Financial. Thank you, sir, so much for joining in. You've performed well in a tough quarter this time compared to what the NBFCs have done. But how is it going to be going ahead? How's the trajectory going to be? What's the on-ground situation? Are you seeing improvement that is coming in for the sector? What's your view?
So our view has always been, one doesn't look at certain temporary pressures one goes through, but what is your long-term readiness to be able to handle the opportunities or the downturn, if any. So if you kind of go back in street to 2 years back, we were going through difficult times. Even then we had maintained the statement to say that, fundamentally our approach is going to be semi-urban, rural, and we're not shifting our strategy from that. Our approach will always be deeper penetration. Our approach will always be multi-product and multi-relationship, and using a very large customer base to be able to generate volumes on our own. I think that's something that we have continued to do so, and that is helping us even in situations as this to maintain growth, and that's what has helped us grow at 24% on our disbursement even in this quarter. One, because of our growth in pre-owned vehicle, growth in commercial vehicle construction equipment, and overall market share growth in every product that we have participated in. So far as liquidity is concerned, again, it comes from how well managed are your cash flows. We have not had a mismatch in any bucket, whether it's in the initial bucket or the long-term bucket, and that helped us really put ourselves into the system and be able to raise liquidity. Yes, of course, it's come with a little increased cost, and we've on record that we're not going to pass on all of that to the consumers. We have absorbed some. We have shared some with the OEMs and the dealers, and some has been passed on to the consumers, which has therefore helped us also maintain our margins. So net, I would think a deeper penetration, multi-product approach, a well-managed cash flow, which helps us raise adequate liquidity from various products that we can raise. And all of this together is what has helped us maintain the growth.
So higher operating costs were seen this time around, and also taxes were there which dented the profit. How do we see the trend changing over the next few quarters?
So clearly, the taxes were a one-time impact of the last 3 quarters of ours, which has come in. But therefore, if you look at on a 9-month basis cumulatively, they do get adjusted, and you see a growth of 30% plus. So I think fundamentally we've done things well, and which is what has helped us to reach these levels of growth rates. And we do believe that this is maintainable even going forward.
So what about asset quality? Because this time around we've seen an improvement quarter on quarter, but over the next few quarters, will there be a steady decline in the asset quality? Will there be an improvement in asset quality going ahead?
So if you look at last 6 quarters, you've seen continuous improvement to asset quality, and we had reached a level of upward of 12-13%, and we have come down to a 7% kind of a level. And definitely, yes, the second quarter for rural always from a cash flow perspective is very good, and we do believe that this year around also we would get the benefit of that for sure. But also it's extremely important to understand one data point that I may want to share with you, which is the number of accounts which are in NPL as of today as I speak to you is lower than what it was March 18. So which is a significant improvement to an asset quality is what I would think. And I think given the sentiments, given the overall cash flow of rural, given our deeper penetration and a specific vertical that we have built, we don't even see forward flow happening in terms of deterioration. So I think overall we would see continuous improvement to asset quality is our take.
What about the AUM growth trajectory? How is that expected to shape up?
So if you have a disbursement growth of anywhere between 20-25%, I think given the maturity of contract that happens, even the AUM growth anywhere between 18-22% can be seen, and we are confident that that kind of a growth rate would be maintained.
What about, sir, what's the on-ground situation in terms of vehicle financing segment? That was a concern point over the past few quarters, and we've seen how the auto sales number, the auto results have come out. Is there still a lot of pain left here, sir?
I think, one after the other has been happening, whether it was the fuel price increase, then the interest rate increase going up. All of that has caused a little pressure on the OEMs at the auto levels are concerned. The stock levels at the dealerships are a little high, but clearly the OEMs are offering various programs, the discounts are continuing. The dealers are finding out new ways to really retail out better, and we as financiers are partnering OEMs and dealers in kind of ensuring that these kind of retail supports made available. So for someone like us, we would think that even in the fourth quarter, with all these programs ongoing, including exchange programs, etc., should see improvement to retail at every dealer point, and we should be one of the beneficiary of that. But yes, the pressure point in terms of stock level and therefore the retail demand is kind of third quarter was a subdued third quarter. We believe that that would show improvement in the fourth quarter.
Okay, and finally, my last question, sir, is that how do you see the performance of your subsidiaries going ahead? This time around it was a decent quarter, but how's the trajectory there?
I think as far as insurance subsidiary is concerned, they are a direct beneficiary of the synergy with various business of ours, and therefore I don't see any reason why they should not be able to maintain their growth rate. So far as the housing business is concerned, again, it's one of our growth engine. They have maintained a 40% plus growth. Yes, they did slow down in this third quarter on two fronts. One, of course, there was a liquidity pressure that caused them to be a little slower, but more importantly, it was a conscious decision to go a little slow in Maharashtra, where they had collection pressures and they have improved upon it, and therefore you see the benefit of it flow into their profitability already. I would very strongly think these two subsidiaries of ours are clear growth engines for us. They contribute to our bottom line substantially well, and they will continue to do so. As far as asset management is concerned, we are a long-term player, and therefore we are very clear about launching a product which suits the rural market. We are in kind of a book size close to about 5,000 crore plus, and we would have a lot of patience, and we would continue to focus on growing of the semi-urban rural market.
Okay, sir, we leave it at that. Thank you, Mr. Iyer, so much for speaking to Bloomberg Quint and sharing the highlights of what happened in the third quarter and what's expected ahead.